Ladies and gentlemen, dear friends, my name is Ernest Knam. I'm Secretary General of SUERF, the European Money and Finance Forum. Welcome to the first edition of SUERF's new Central Banking and Finance webinar series. We are very pleased that Pfeil and Tamarah Shakir from the ECB, as well as Andreas Pfeil from the EBA, have joined us today to share and discuss their analysis on the state of play and the prospects for financial stability in the euro area. Jokivuolle from the Bank of Finland will moderate the meeting.
Thank you very much, Ernest, and welcome everybody also on my part. So before introducing the speakers briefly, let me just say that as is well known, the Financial Stability Review is one of the flagship publications of the European Central Bank, which is published twice a year. This spring, obviously, given the wide impact of the COVID-19 crisis we are witnessing, there is a considerable amount of additional interest in the findings and recommendations of the review. So therefore, it is a great pleasure to have Pfeil and Tamarah Shakir from the ECB to present us the fresh report. John is Deputy Director General for Macroprudential Policy and Financial Stability, and Tamarah is Deputy Head of the Systemic Risks and Financial Institutions Division. The discussant will be Andreas Pfeil. Andreas is a Senior Bank Sector Analyst with the European Banking Authority. Very happy to have you also with us today, Andreas.
So let me first thank Ernest for the kind invitation to Tamarah and myself to speak at SUERF today. Ernest and I share a common career history working together at the European Monetary Institute. More time has passed since then than I would care to mention, but it's a real pleasure to participate in this event with Ernest. The latest issue of our Financial Stability Review was published last Tuesday, so we are still hot off the press with this presentation. Obviously, the COVID-19 shock dominates our financial stability assessment this time, but it has also brought to the fore several themes and issues that have preoccupied our financial stability analysis for some time now. Now, the way that Tamarah and I have planned to organize ourselves is that I will give a broad overview and then she will dig deeper into policy aspects. But before I start, I have the usual disclaimer. While the FSR is approved by the Governing Council of the ECB, any views expressed by us in the Q&A may not necessarily reflect the views of the ECB. So now turning to slide 2, while the spreading of COVID-19 within China had been prominent in the Western media throughout January and February, it was really not until it had migrated to Europe and threatened an exponential increase that European financial markets took notice. That was around late February. And since then, we have learned much about the health, social, and economic consequences of COVID-19. And as the infographic on the left illustrates, there is hardly an aspect of economic life that has not been affected. Now, while the shock has global consequences, we should be mindful that there is not a single global pandemic wave. Resources and vulnerabilities of different countries and regions are being variously impacted at different times. And the containment measures, as we know, have been drastic. They have curtailed aggregate demand while also disrupting the supply side of economies. The baseline, to the extent that we can be confident in one now, is a global economic contraction of unprecedented scale. Market expectations adjusted abruptly to the changed outlook, and as they did, the resilience of the financial system was and is being tested. Now, while financial system stress was first and foremost triggered by a real economy shock, we recall in the review that we had for some time been highlighting several sources of risk and vulnerabilities for euro area financial stability. And those included overvalued asset prices, low bank profitability, high sovereign indebtedness, and low liquidity buffers in an investment fund sector that has tripled in size since the last crisis. So in many ways, what we saw was an unearthing of those vulnerabilities. Now, moving to slide 3, the left chart shows that not only have euro area GDP growth expectations for this year been slashed, but uncertainty about the outlook is also very high. Worldwide, there was an immediate recognition that the first line of defense for an aggregate demand shock that threatens the incomes of households and the solvency of firms is fiscal policy aimed at replacing income and mitigating the impact of cash flow collapse on debt service. Now, the extent of the fiscal response can be seen by the expected surge of the euro area deficit to GDP ratio to an unprecedented 8%, as you can see there on the right. This should moderate adverse impacts on growth potential, and even though it was not the primary intention, these measures are shielding the core banking system from credit risk as well. Now, going to slide 4, as I mentioned, we had pointed out in past issues of the episode that an aggressive hunt for increasingly scarce opportunities for yield meant corporate bond spreads were priced for perfection on the eve of the COVID-19 shock. Search for yield had also pushed stock prices to valuation levels that appeared high given the fundamentals, and it had also lowered market volatility to the point where it had become an anomaly. Now, even if asset prices were not misaligned, a change of the fundamentals would have warranted declines in stocks, a widening of spreads, and a surge of volatility. However, which is what we saw, but when one considers that a share price represents the net present value of dividends, not over the next year, which is the likely horizon of this shock, but over future decades, declines of 35 to 40% within a month appeared exaggerated, suggesting to us our sources of amplification. Now, some evidence for amplification mechanisms are shown on slide 5. The left chart shows indicators of corporate bond market liquidity. The line labeled ETF NAV basis, that's the spread between the net asset value of the respective exchange traded fund and the value of the index that it is tracking. There's also a CDS basis there, which is similar, but here the spread is between the credit default swap premium and the spread on a portfolio of corporate bonds. Both indicators, as you can see, turned negative at the height of the stress, meaning that pricing in the derivatives markets moved faster than in the cash market. But then there was persistence of those negative gaps, and that would tend to indicate that investors were shying away from what should have been risk-free arbitrage, suggesting that some institutions faced balance sheet constraints. And constraints on investors, of course, mean that market liquidity is lower because they're not participating in the market. Added to that, there was remote trading, and that didn't help with market liquidity either, as risk limits, we were told, were caught on traders working from home. Now, in box 2, we also explain how volatility targeting strategies, so I have in mind things like, for example, risk parity, that they may have also amplified adverse market dynamics. The number of risk parity funds globally is considerable. We have figures in box 2 on that. Now, turning to slide 6, the investment fund sector was very much at the epicenter of the market stress. And here, too, there were pre-existing vulnerabilities. Cash buffers were low, and hedge fund leverage was rising before the COVID-19 shock. Now, redemption requests tend to be pro-cyclical. Investors often want their money back when asset prices are falling. And initially, as seen on the left, a typical flight to safety pattern unfolded. Corporate bonds and equity funds faced unusually large outflows, and at the same time, money market and sovereign bond funds benefited from the flight to safety. Then, in mid-March, as market liquidity dried up, we saw a dash for cash to meet redemption requests and margin calls, triggering extreme outflows from money market funds. That's the green line on the left. And it took the announcement of the ECB's 750 billion euro pandemic emergency response program, and also, by the way, 9 separate programs by the Fed to stabilize markets. Yet, alarming vulnerabilities were revealed in the investment fund sector. The right chart shows that outflows from corporate bond funds were on average larger than their cash balances. Now, redemptions and margin calls were met partly through corporate bond funds drawing down on cash that they were holding, actually some of them with money market funds, and that was part of the reason for the stress on the money market fund sector. But they were also forced to sell assets, and in doing so, of course, selling assets in a short period of time amplifies and did amplify the disruption. Now, turning to slide 7, the market stress has also brought to the fore sources of interconnection and feedback between banks and investment funds. In box 6, we identify several sources of interlinkage between banks and funds. They include ownership links, some banks own funds, also funding, that's shown on the left, the funding of banks by funds, and also counterparty and, importantly, common exposure links. And the importance of these shouldn't be underestimated. Large euro area banks and bond funds have significant common exposures, and that's seen on the right there. And this contagion channel increases the risk that forced selling in the investment fund sector results in mark-to-market losses for banks. Even if they're not selling, they will still suffer those mark-to-market losses, as we have seen. Now, turning to non-financial sectors, on slide 8, the chart on the left shows a scatter of household sector vulnerabilities with unemployment rates on the x-axis and liquid assets of households on the y-axis. Countries are then sorted into terciles based on the intensity of COVID-19 infections, and that determines the color coding of the countries. So the worst combination of high unemployment and low liquidity, so vulnerabilities being greatest there for the household sector, that's in the bottom right quadrant. And you can see that 3 countries marked in red, and those are the ones with the highest infection rates, are also in or near that quadrant. Now, while fiscal measures supporting income mitigate some of the cash flow and household sector credit risk, our house price risk models shown on the right there are showing much higher probabilities of housing market corrections in the euro area than they were just a few months ago. You can see on the right that the whole probability distribution for future house prices has shifted to the left with a much larger left-hand side tail. Commercial property is not shown here, but it's also expected to come under pressure going forward. Now, moving to slide 9, even before the COVID-19 shock, euro area corporate sector fundamentals were deteriorating, profits were falling, and rating agencies were already downgrading more euro area corporates than they were upgrading. Now, you can see there on the left a surge of short-term loan demand in the euro area, and we think that reflects a drawing on bank credit lines by corporates, corporates suffering cash flow challenges, or because they may have had precautionary reasons because they were worried that they would be running into cash flow problems in the future. Also, some of them may have had difficulty in rolling over their paper in the market, especially because the corporate bond market clogged up at times. Now, while rating agencies have not so far downgraded firms as aggressively as they did after the collapse of Lehman's, there are concerns that the euro area corporate bond market is much larger today than it was then, and almost half of euro area corporate bonds are currently rated BBB. So they are at the borderline of what is called between investment grade and junk, and that's the so-called fallen angels threshold. 60% of those bonds are now on negative watch, and we estimate, you can see it on the right there, that around 100 billion euro of those bonds could be at risk of being downgraded. And if that is right, because you can see it also in relation to the size of the high yield market, that could overwhelm the high yield market, triggering renewed financial market stress. Now, turning to slide 10, although we are not assessing it as a near and present danger, concerns about sovereign debt vulnerabilities have been highlighted in past issues of the FSR. And while we fully believe that fiscal policy has responded absolutely appropriately to the crisis, it will, of course, in the medium term, exacerbate those vulnerabilities. Now, beyond the fiscal stimulus, which averages at around 5% of GDP for the euro area as a whole, guarantees, and many countries have activated them for firms lending, they create contingent liabilities, which of course have a higher likelihood of being booked as actual liabilities if the crisis persists for longer than we think. Now, we're particularly concerned about those countries that had limited fiscal space to begin with, and as you can see, those countries are the ones that see the largest increase in debt to GDP ratios. And that, by the way, is not only because debt is rising, it's rising in all countries, but it's also because GDP is falling in those countries as well, so we shouldn't forget that. Now, turning to banks, to the banking sector on slide 11, the sector was, of course, one of the hardest hit in the initial equity market correction. Pricebook ratios reached all-time lows of 0.3 on average, but some fell even lower than that. And you can see that in the middle panel there. There's a box plot showing the ranges of where current Pricebook ratios stand. Now, although the banking sector entered this turmoil much better capitalized than was the case in 2008, and with more comfortable liquidity ratios, all thanks to the regulatory reform that we have seen over the last 10 years, this decline appears to reflect both the decline in stock prices, a sharp increase in uncertainty and a deterioration in the bank profit outlook. Now, slide 11 illustrates a bit more on that. It shows that, slide 12. It shows that analysts have cut in half their return on equity expectations for euro area banks, both for this year and next. Notably, though, they still expect positive returns for the banking sector on average in both years. But we know that depending on underlying profit-generating capacity and, of course, also exposures to those economic sectors that have been hit the hardest by the COVID-19 shock, differences in profitability performances among banks can be expected going forward. We have concerns that there are some banks that have both low margins and high exposure to those vulnerable sectors, making their profitability vulnerable. Slide 13 looks at banking sector vulnerabilities in a bit more detail. The chart on the left shows ranges of possible losses that could result from cash flow disruptions from firms. This is all explained in detail in the review. We just basically looked at different assumptions of, how much of the cash flow disruption could be possible, ranges of possible cash flow disruptions. You can see there Italian and Portuguese banks stand out. The chart on the right then is based on a sort of a reverse stress test. It's basically asking the question, by how much would loss rates on exposures to those sensitive sectors, so there's travel, autos, leisure, etc., how much would those loss rates need to rise before the voluntary buffer, so those are the management buffers that banks hold in blue, and then all buffers that are above the core equity tier 1 minimum requirements, that's in yellow, would be depleted. So basically, so it shows the shock absorption capacity in a kind of a way reflecting the risks the banks may be facing. So high bars here are good. It shows that all banking systems in the euro area have the capacity to absorb around 20% of losses on those sectors, and some much more than that, as you can see. That said, there are some above below the euro area average: Spain, Greece, and Italy, as you can see on the chart. Now, moving on to slide 14, I said at the start that some fiscal measures are aimed at preventing corporate bankruptcies. In fact, if fully deployed, guarantees could avert 15 to 20% of corporate loan losses. However, they do raise several issues. One of them is the contingent liability one that I mentioned already, but there are other issues, including level playing field and fragmentation issues, because there has been unevenness in those measures across countries, as we know. So far, though, their take-up has been low, so that would augur well for the contingent liability risk that I mentioned, and perhaps it is a bit early to assess their effectiveness. Then beyond the fiscal response, monetary policy responses were rapid and substantial, and there was significant prudential action as well, both micro and macro, which Tamarah will speak about in a moment. But first, let me sum up on the financial stability outlook summarized on slide 15. And a key point that I want to stress here is, thanks to the earlier regulatory reforms, the euro area financial system has demonstrated resilience and an ability to cope with the initial market shock. Looking ahead, though, further stress can be expected from weakened corporate cash flows, and as downgrades rise, as they will, it may force some asset managers to dispose of what is currently BBB paper. So we may see further market turmoil ahead, especially as market intelligence is also suggesting that many fund managers now believe that just as they overshot on the downside, asset prices may have overshot in the rebound as well. There are also, as I mentioned, concerns about bank profitability going forward and possibly the unevenness of it. And then further ahead, fiscal measures are crucial for preventing economies from collapsing. So we have avoided that, but of course they raise those concerns about sovereign debt sustainability that I mentioned, especially if defaults trigger activation of guarantees, and that in a total worst case scenario could even reopen the sovereign bank nexus. But that's certainly not our baseline. It's just simply one of the downside risks. So we expect the period ahead to be challenging for financial stability, especially if we get, as is stated on the slide there, a second wave of the coronavirus as containment measures are currently being lifted. Of course, also economic outcomes could disappoint as well. So they would be possibly the most important triggers for further financial stability concerns. But let me hand over here at this point to Tamarah.
So yes, as John said, I'll move on to discuss what this has meant and means for policy measures and their impact. As John has set out, while the ramifications of the pandemic are pretty massive, policymakers have responded with pretty massive relief measures themselves, and that should be meaningful in trying to reduce some of the immediate economic pain and also help our economies be in a better position for recovery. John already touched on fiscal and monetary measures, and I'll come back to those a little bit, but for those of us working in financial stability, prudential policy measures are a big focus of our attention, and especially because this has been the first real test of the post-2008 reforms and the new framework. I think many of you are aware that a key element of the reforms to bank regulation were to raise the quality and quantity of capital banks hold in good times, particularly through regulatory buffers, so that these buffers are available to absorb losses in stress periods and therefore avoid costly deleveraging by banks in a credit crunch. I'll talk a bit about capital here, but there is an equally important parallel approach to liquidity, where liquidity buffers are held normally so banks can draw on them in stress and avoid liquidity and hoarding. But the thing that's happened in the last few months is our colleagues in the SSM, as well as in national central banks across the euro area, moved really quickly when the economic implications of the virus were becoming clear to enact measures to enhance the usability of buffers through a combination of announcing outright reduction in some regulatory requirements and through guidance, easing guidance elsewhere. Those measures cover in total around 140 billion euro of core capital, combined of Pillar 2 buffers, counter-cyclical capital buffers, that was the new macroprudential tool that was put in place, as well as through some release of other systemic buffers by national authorities. We think in total this should have a pretty significant impact on reducing banks' incentives to delever and therefore excessively constrain credit, even as they face losses on existing loans. But we do have to recognise that just easing the requirements or guidance around buffers alone may not remove all the reasons for banks to protect their capital ratios. One issue that could arise to inhibit that has also been addressed with the parallel recommendations for banks to not pay dividends in the latest season. So without this recommendation, I think there's two things to note. First, there may have been incentives for banks to delever to avoid their capital ratio, that is capital over assets, falling below thresholds, which means a bank individually has to withhold distributions to shareholders. By putting all banks in the same position, that relative incentive changes. The second benefit of the recommendation is that if banks had paid out in Q1, Q2 this year as they planned, a material slice of capital, we think around 27 billion, could have been extracted just before banks might be facing a wave of losses. Indeed, the chart on the left here indicates that in the euro area, and actually across advanced economies, dividends and distributions from banks to shareholders have been increasing in recent years. Box 5 in the FSR, though, which goes through recent patterns in both dividends and also share buybacks, also sets out that there's been a recent observed correlation between distributions to shareholders and bank valuation, and that's indicating the positive relationship, and particularly for euro area banks in the yellow dots in this scatter plot on the right here. So what does that mean that we find that positive relationship? Well, in the face of such an enormous economic shock, large payouts to shareholders now that made the banking system as a whole vulnerable to distress would be unlikely to support any bank's valuation, and I think that seems pretty intuitive. But the analysis here is a reminder that over time the restrictions may have implications for market valuations of banks, and that in turn has an implication on the cost of external equity raising for banks. So that parallel recommendation fits with measures on capital to help cement the release of capital buffers. Alongside the direct action on capital requirements, there's also been a set of other policy measures which de facto provide further relief for banks. They range from delaying introduction of the new incoming requirements through Basel III, or as they would have been implemented through CRR2 in the euro area, also to guidance or changes to regulation about how banks should be applying the new accounting or non-performing loan measures and avoid banks applying them in an overly cautious way, which is set out in the bullet points here. So I think many of you will be familiar with the shifts in IFRS 9, the accounting standard, which has and how that treats expected credit loss. So banks have to take a more forward-looking to their provisioning approach now. The guidance was to avoid banks in being forward-looking inadvertently being too pro-cyclical or too conservative, which in turn would have led to an unnecessarily harsh and rapid depletion on capital. Furthermore, there are also kind of tools that are still available to consider as time proceeds. So if the pandemic does lead to deterioration in bank asset quality, there is still room for more decisive action to be taken to address non-performing loans. And there, many of you will be familiar with the debates underway now on the role of asset management companies if that's needed to help with workout. So it's, here, thinking a little bit about the impact of those measures, it's far too early for us to declare victory against the systemic financial distress or even to give a meaningful assessment of the impact of measures. It typically will take some months for any loan losses to work their way through, of course, and there are many more events that could arise. But nonetheless, that hasn't stopped us in this FSR from trying to at least understand the order of magnitude and potential impact of policy measures. And box 8 in the FSR is one of those attempts, and I've set out here a couple of charts from there. So that box uses a DSG model with a capital-constrained banking sector, and then uses some illustrative macroeconomic scenarios, broadly in line with the kind of GDP impact John set out earlier. The authors tried to shed some light on how the policy response so far may affect GDP outcomes and the particular role that capital measures might play. So looking at the two charts here, I wouldn't necessarily attach a lot of weight to the point estimates, but more to note that firstly, the marginal impact of policy measures on the left, so if buffers are used, could be quite significant over the next 2 years. And the model illustrates the benefit that you can get through the banking system of being able to prevent pro-cyclical responses in the banking sector. And that's a material gain for economic outcomes. Secondly, though, and I think that's an interesting finding, that the model finds that the prudential measures could also enhance the impact of fiscal and monetary policy measures, particularly in 2021, which is indicated by the top of the bar on the right here being higher than the red dot, which represents the model result and without the benefit of prudential measures. And that, again, I think is a value reminder of the gains that we might have and for being able to lean against pro-cyclicality in the financial sector that impairs the transmission mechanism of other policies. So hopefully being able to utilise this new element of the framework in this crisis leads to better outcomes than we've seen in the past. So finally, while prudential authorities have sought to use the tools they have, events have though highlighted some areas where more could be done, and I've drawn out two here that are set out in the FSR. Firstly, with regards to tools for non-banks, as John described, we had this episode with money market funds in the middle of the crisis and in the middle of the stress period in markets, and that drew attention to, in particular, I guess, the tensions you can get between the liquidity mismatch in non-banks that we've been discussing for some time in the FSR. And although monetary policy measures were able to step in and respond to market stress through a range of schemes, it also highlights that having an effective macro-prudential framework could have been a more It could then lead to more efficient outcomes, particularly having a combination both of more ex-ante tools that could effectively mitigate the build-up of liquidity risks during the good times, but also being able to have a suite of ex-post tools, additional supervisory powers that would allow or support liquidity management in periods of distress. We haven't talked much about insurance companies in this presentation, and they have and are set to face also some pressures, both in terms of their solvency, but they've been put under pressure a little bit too at times in their liquidity. And there we also find that there's need to strengthen, and then although there would be benefit in strengthening the Solvency II framework to again allow more counter-cyclical approach to capital. And then very finally, we've talked a little bit here about the potential risks around fragmentation that might come out of the implication of some of the policy measures taken during the stress period, but more broadly, continuing progress towards completing banking and capital markets union could help with the recovery and would allow better basically risk transfer across the euro area. That's through both banking union measures, so that we have a level playing field in terms of depositor protection, but also in having more integrated capital markets that would help with risk sharing and coordinated action across Europe. I think that's it for me. I'll leave you with the summary slide from our financial stability review, and of course encourage you all to go and read it. It's available on the ECB website. But here I think it builds on John's comments that we have marked increase in vulnerabilities overall, but really some of them are amplification of vulnerabilities we've been talking about for some time. Thank you.
Thank you very much, John and Tamarah. Indeed, very interesting presentation. And now it's time for comments by Andreas.
Yeah, also thank you from my side for the invitation, and happy to be discussant. So as a starting point, we saw it very well, and there's been a major economic contraction, and the chart on the top left summarizes it quite well. It shows the 2020 GDP forecast, how it evolved over the year. In the beginning, still quite positive, and then becoming strongly negative and widely dispersed. And this is actually what John also said in the beginning of his presentation. So coming from the EBA, our focus is of course a lot also on the micro and prudential view. And when the crisis emerged here and started here to spread, the virus started to spread here in Europe, and the first concerns were about the operational resilience. So, but banks proved to manage this quite well. So they were quick in establishing remote working. They also started closing branches, also because customers did not come anymore. Digital channels were used for as common online banking, but also for communication with clients. The only part where we saw some challenges were seen was in the huge workload resulting from the applications, in particular for guaranteed loans, where some banks struggled, and they reshuffled then responsibilities within the teams, and so they managed it quite well. Also related to offshore units, in particular in India, some challenges were reported actually, in particular from the bigger banks, because units there were not so well equipped and prepared for remote working. Then another key worry from the very beginning was, of course, how is it going with liquidity? Buffers were huge. Also as already shown by John and Tamarah, SCR is high, well above requirements, and this is shown in the top left chart and from the FSR. And actually in the bottom left, you see the development during the first quarter of this year. So the LCR also, it stayed very stable. It stayed quite stable. So no major issues in respect of liquidity. Well, some countries And while we know from 2 countries that reported some increase in withdrawals of cash, but not being a major concern actually, and this was just for several days. Of course, funding markets under stress, in particular in the beginning of the crisis, but well, they recovered now slightly. Prices are, of course, still elevated. Interbank funding, while Euribor rates increased. So also there some stress seen, and going forward, the assumption might be that funding prices will not recover so quickly, not go back to pre-crisis levels, might still stay elevated, and in particular, MREL funding might become a challenge for some banks. And then the key worries, of course, also I think is quite well reflected in John and Tamarah's presentation, of course, the asset quality. So there's also then the question, where are the key vulnerabilities? Of course, one part might be households, the unsecured lending, so the common consumer finance part, and in the NFC portfolios, then the question, which are the most affected sectors. So, of course, everything related to tourism, transport, manufacturing, this might be particularly vulnerable. So we published this week a report then focusing on the COVID impact on the EU banking sector, also available online. And in this report, from which we took this, the charts, and we also have a sensitivity analysis for credit risk. So we showed that the impact from a deterioration in asset quality might range from 230 to 380 pips of CET1. So this is, of course, a high-level sensitivity analysis based on the stress test 2018, but building on year-end 2019 data. But when we try to compare also with the results from the sensitivity analysis for the NFC exposures from the FSR, and it seemed to work quite well. So this is what you also saw in John's and Tamarah's slides on the bottom right. So this is from the FSR. And then trying to bring this together, of course, with asset quality and maybe also other stresses, looking at banks' capital. Well, also already mentioned, capitalization is quite well of EU banks. We have a CET ratio of nearly 15% as of year-end. There have been the measures on the buffers, macroprudential buffers. There have also been other measures already mentioned, like the dividend retention initiatives, and also, for example, the SSM then allowing banks to fill the P2R not only with CET1, but also AT1 and Tier 2, which was common outside the SSM area anyhow, but was further clarified in the upcoming CRR2. The SSM postponed this measure then, which also helped banks. So looking at a CET1 ratio then of 15%, this gives us roughly around 300 pips above OCR and P2G. When we add the measures, the mentioned ones, this brings another about 200 pips of buffer. And if we add, in addition, the P2G, this adds another about 100 pips. So we have a buffer above OCR after measures and including P2G of around 500 pips. And this is something you can now see in the top left chart, where we come from the CET1 ratio as of year end 2019. We add, for example, the dividends. We then deduct the OCR, the requirement. We add the OCR measures. We deduct the 380 pips from the credit risk sensitivity. And we see then that we have a buffer of around 1.1% above OCR. Of course, well, fully understood that this cannot be fully used for lending, and the FSR shows, for example, the chart on the bottom left shows the approach from the FSR, and then applying, staying on the management buffer. This can be used for lending, but also, of course, clarifying banks will not use this in full. There are, of course, many other risks when you take, for example, our sensitivity analysis. There's market risk, there are drawings of credit lines. For all these risks, we also included sensitivity analysis actually in our report. And what is also important to stress, there's of course huge dispersion of the impact and the capital buffers. So there are banks falling well below OCR, but there are banks which stay well above the OCR in the sensitivity analysis. One has to differentiate between banks, and supervisors will of course have to carefully look at this. And the conclusion is, of course, while we have challenging times ahead, also as already said by John and Tamarah, banks enter the crisis in a strong position, and the challenges are unprecedented. Nobody knows how it's going further, how many waves will come. So we see it now already coming up in South Korea again. Well, there was a quick reaction from regulators and supervisors in many areas in respect of operational resilience, but also many other topics. Banks have successfully coped with the pressures on operating capacities. But it has to be seen how it's going further with different kinds of risks, market risk, but also then in particular credit risks. That's it from my side. Thank you very much.
Okay, thank you very much, Andreas, for these remarks. And now we have already a collection of questions here. Let me start with the following question. How do you see the need for the recapitalization of private corporations in the next few months? How might this be best done in terms of institutions? Is there a role for a privately and or publicly funded big European recapitalization fund?
Concerns raised about or acknowledgement of the losses that banks are likely to face, and those could be significant. There's already been a huge amount of policy measures taking place, so it seems premature to be certain that we're going to end up in a situation where such measures are needed, and that's not the central expectation that's set out in this FSR. And of course, the debate about what could happen in tail events or if things get much worse has been considered. And there, you might want to think about what are the mechanisms. There are mechanisms in Europe. They can be made to work already through the various funds, and also now other funds being discussed, which which would have a pan-European approach to mitigating some of the risks that could arise in the future. But in terms of specific design, it's not something that we've got engaged in directly in this FSR. John, I don't know.
Yeah, sorry, I was speaking with my mute button on, so but I think you've answered it very well, Tamarah. I don't think there's anything else that I would say. I mean, I think the main point is that what you said, that it's a bit premature. There are all these other fiscal measures already. Of course, the concern is that at the end of all of this, we end up with much more highly indebted firms, and that creates a vulnerability going into the next cycle, of course. But there are different ways of addressing that, and one would be, more so-called equitization, possibly debt for equity swaps. I don't know. I mean, I'm really talking now a bit out of the box because we don't have anything. We don't make any concrete proposal on this in the FSR. But I mean, it's a tail risk, and we have seen that in some countries this is what is happening, of course, as well. Recapitalization of firms. So it possibly will be part of the overall crisis management package. But yeah, I mean, I think we still have to wait and see, how big. So I think somebody said it already that as this crisis morphed from a liquidity crisis into a more kind of a solvency type of crisis, which it has turned into now. the liquidity part tends to be high frequency. The solvency part tends to be lower frequency. So there will be time to understand, and as we see, the performances of the firms, and I guess the appropriate policy response will be taken. But for now, I think that there is a lot of comfort in the capacity that has been created in terms of the guarantees in particular. I think they have been extremely important for the corporate sector.
Okay, thank you. There's the next question. What are the risks to European financial stability associated with a growing and possibly accelerating geopolitical and economic tensions between the USA and China?
From time to time, when these risks surface, these are sometimes can be triggers for euro area financial stability vulnerabilities unraveling. I'm not going to make political predictions here now, of course, but if geopolitical tensions rise, they often, but not always, lead to stresses in financial markets. We certainly saw it in the oil markets through this, of course. So that's certainly one. So we know that it can have an impact. But although remarkably, and I said it at the beginning about the market volatility being an anomaly. We did some empirical work in the past on trying to understand why market volatility was so low. What were the drivers? I think one of the things we found out why it was becoming a bit of an anomaly was because we were finding it more difficult to explain. And in the past, those indices of political risk were explained a large fraction of the variance in market volatility, but it's not as pronounced today as it was. Okay, I'm talking about at the eve of COVID-19. We haven't updated that, but sure, yeah. Geopolitical risk always can create risks for financial stability.
How do you view the sovereign bank nexus, which was already much discussed during and after the global financial crisis, but was never resolved thereafter? It seems to be a major source of risk again. How to address and cope with this risk now? Well,
on that one, I said at the end that we're not seeing much evidence of it at the moment. By the way, it's not. We know it's present. It's a potential risk, but the market certainly doesn't seem to be pricing that in. Members of the board of the ECB have been very clear that one thing on the monetary policy side that we absolutely want to avoid is asymmetry in the monetary policy transmission mechanism across the euro area. And what we mean by that is that monetary impulses should have the same effects in different parts of the euro area. And we don't see evidence of that. Of course, we are purchasing sovereign bonds, as you know. So that certainly has been helping. When you look at it, also, in terms of, a lot of people ask the question, you say on the one hand that the fiscal response was the right one, but aren't you contradicting yourself then by saying that there is a risk created by that? But the sovereign debt sustainability risk. But my answer to that always is that you need to think about the counterfactual, and what if you hadn't had the fiscal responses that we have had. You would have had bigger, deeper collapses in economic activity than we have seen, and probably that might have led to a worse scenario. I have no doubt that it would have, because the work that Tamarah showed that the GDP impacts of all the measures are positive. We get big numbers, big impacts, although the size of the shock is so large that it's not possible to offset everything. But for now, I said it, and I think I was clear in saying it. We don't see it as a near and present danger, but of course we know that sovereigns are going to have to manage, going into the recovery with higher debt to GDP ratios, and there will be a need for a certain amount of deleveraging.
Okay, thank you, John. There's a question here, particularly to Andreas. Andreas, would you be ready to take one?
Yes, ready to take it.
Good. So this is from Hanna Westman, who is with the Finland's Financial Stability Authority. The question is that, Andreas, you mentioned the increased challenge of banks to issue the so-called MREL-eligible liabilities. What do you see as crucial events needed so that we would get back to a positive development, ensuring that banks meet MREL requirements?
Well, a key challenge, a key point would, of course, be that financial markets stabilize again, that volatility again contracts. Well, it has already much more normalized compared to the peaks in March. And as soon as there's also more stability, or when it's getting clearer, more clarity on how the risks materialize with the banks, then it should also become easier again to issue MREL eligible debt, and then in particular also for, let's call it, banks which are considered more vulnerable. But also at the very moment, the big ones are able to issue, well, also from periphery. So it's not like the funding markets or the primary markets are dead. Well, there is activity, huge activity that have also been AT1s, Tier 2s, and so on, at higher pricing, but of course, issuers mainly the big banks. But as soon as there's more clarity how all the risks materialize, then it should also be easier for the other institutions to come to the markets again. Of course, this will depend a lot also on more clarity in respect of further waves of the virus and this kind of risks.
Okay, thank you very much. The next question, we still have a couple of minutes left. I believe this is to John and Tamarah. So given the current price to book values for banks compared to the past, can we really be confident in saying that banks are safer now?
Well, I mean, I could be smart ass in my answer and say the price book value reflects the market valuation and the market assessment. I mean, there are actually some market analysts who think that banks are the European banks are very underpriced at the moment. So, I mean, I think one thing that we know about bank stocks is that they're over time, with the performance of banks in Europe over the last number of years, the investor base has narrowed somewhat. And so there may be liquidity issues in the pricing of banks, but I mean that valuation reflects a risk premium that we would expect in time will go away. That said, that the price book ratio reflects. I mean, it's basically another way of thinking about the price book ratio. It tells you about where the cost of equity for banks is relative to the return on equity on banks, and of course that means that the markets are pessimistic, but not so pessimistic about earnings potential, because as I showed, the return on equity is still expected to be positive. I must say that at the beginning of all of this, I was kind of expecting that there would have been a total slashing of profits, of profit expectations for euro area banks. It didn't. It happened, but slowly, as I think market analysts began to understand that maybe the V-shaped recovery was not the most likely scenario. But I definitely would expect some recovery there. So I mean, while in general, I was saying that there might have been some euphoria in other parts of the market, I don't think it certainly hasn't been the case for banks. But I think it's more risk premium than it is expectations, and risk premium to the extent that they are elevated at the moment. They will normalize, and if they do, then European banks would be a good investment. I'm not, by the way, making a recommendation to buy European banks, but they do look cheap.
Okay, thank you. Maybe one last question. You also mentioned the borderline between banks and non-banks, that there may have even been some surprises what the exposures between the two have been in the recent market turmoil. We know that after the global financial crisis, there was a lot of regulation trying to regulate that border and sort of control the hidden exposures from non-banks or shadow banks to banks. But what about this new emergence of those risks? Did we miss something in the regulation in the past 10 years when we tried to regulate the border better, or are these new exposures of some new type of nature?
So, I mean, what I showed on the slide, where the kind of this indirect contagion, so to speak, is something that I don't think very much can be done about. I mean, unless you ask banks to hold different types of assets to investment funds. But maybe I'm glad you asked that question, because one thing that I didn't have a chance to emphasize, I should have emphasized in the presentation, was I think one aspect that is a bit underemphasized is the importance of CCPs. And CCPs basically have acted as a kind of, I would call it a shield wall between the non-bank sector and the banks. And so basically, I mean, we didn't see banks contaminated with counterparty defaults. We didn't see actually many defaults of financial firms in general, but banks were protected from counterparty. We have seen some hedge fund failures, of course, and I mean, that's very different to what we had in 2008, where banks were on the front line for that, and I mean, they were hit already in the first wave of the stress. So, I mean, I think that is what, that has been hugely important in helping the banking sector to avoid the full impact of the market stress in the early stages of the crisis, the CCPs. So I don't think there was anything that we anything big picture that we overlooked. I mean, the regulatory reform, I think that was done there, I think has been the right one.
Okay, thank you for all the speakers. Very happy that you were with us today.
Yes, I would also like to thank John, Tamarah, Andreas, and Asa. This concludes our seminar, and I wish you a nice evening. Thank you for participating and for your interest.